Yes, hi. This is Michael Felman from MSF Capital Advisors. I want to thank Super Return for putting on, as usual, a great conference. I've participated in many of these conferences before, and they've always had great speakers and content. So, as James mentioned, this panel is LPGP head-to-head fundraising and capital deployment opportunities. And I'd like to at least have our panelists introduced, and before we get into questions, and we'll start with ladies first. Cathleen, why don't you introduce yourself and tell everybody a little bit about your firm and what you do.
Thank you so much, Michael. This is Cathleen Ellsworth. And as well, I'd like to thank Super Return North America, and it's an honor and a pleasure to be here. I'm on the GP side of this LPGP debate, as I have been for, believe it or not, now going on about 30 years. So my background is I joined First Reserve, which was an energy-focused private equity and infrastructure manager in 1990. And in 2017, BlackRock bought the infrastructure product line of First Reserve, and I went with the 40-person team to BlackRock. So in that sense, I've either had one job or two jobs for the last 20 years, but all around investing in alternatives and specifically private equity and infrastructure, generally in energy and power. And my role has been fundraising and IR and co-investment. And so I always tell people, I think I've got a pretty good track record, and I'm proven in two things, raising money and raising boys. And everything, I have two sons, and everything else is up for debate. Thank you, Michael.
All right, Gary, why don't we go to you next?
This is definitely the OG panel of energy fundraising.
The old guys?
Yeah, the original gangsters, Kathleen.
Oh,
original
okay.
gangsters.
Okay.
They don't have that in credit. They don't have those in credit.
Okay.
So, yeah. So I've been doing this for 16 years, very similar role to what Kathleen's been doing for longer at Lime Rock. We have been in business for 22 years. And we do energy, private equity, two oil and gas strategies. One is growth equity and E&P and service. One is actually buying properties through Lime Rock Resources. And just last year, we launched our first new clean energy strategy, and we had our first closeout earlier this year.
Great. Next person, almost last but not least, Chuck, why don't you give us a little bit about your background?
Sure. Thank you, Michael, and thank you, Super Returns, for having us. Ironically, I was asked to be on this panel when I was head of alternative investments at Bessemer Trust, which is a much bigger allocator. During the pandemic, I decided to switch jobs and actually jump into a single family office where we are both an LP as well as a control investor. The family I work for has been investing since 1993 as an independent privately owned organization in and around the power complex, energy, and for the last 10 or so years in sustainable investing. We make, as I said, control investments, but we also make LP investments, and excited to be here today talking a little bit of my perspective from Bessemer and a little bit from my new seat at Fortistar.
Okay, and as I mentioned, I'll give you a little bit about my background. I'm Michael Felman. I started MSF Capital Advisors, almost over 20 years ago. It's kind of a hybrid single-family office, multi-family office. It's my family that I started with my two brothers, and then we have about 60 families, which is a fairly large operation. Energy and power has been a big part of our investment portfolio, both here in the US and abroad. We have investments in E&P companies, services companies, frac water companies, power company in Africa. And then we have looked at various funds as well over the years. We look at our fund investments as more complementary, kind of sounds like what you do, Chuck, to our direct side. I also want to mention, we want to make this as interactive as possible. So if you, post questions in the Q&A, we're hoping happy to get to them. So the first question I have for the group is, how are LPs thinking about capital allocation and commitments to the energy sector, given today's economic and climate-centric environment? I know that's a long, twisted question, but who would like, Chuck, how would you like to go first on that?
So why don't I share just some perspective from my chair, and then obviously, Cathleen and Gary, who are talking to LPs all the time, can add in. I would put it in two different camps. I would think there are those who look at the world and realize that we need energy in all types of shapes, forms, and sources forever. And the question is, how do you achieve that? And the price of oil is one short-term indicator, but the long-term value is created in periods of uncertainty, dislocation. And from my perspective, the smarter LPs have a persistent approach to allocating capital to strong hands, regardless of the economic, political environment. I would offer, however, and Kathleen made a reference to this earlier on our pre-call, there are some more alarmist type of investors and constituents who would tell us today to turn off all types of energy except renewable. I understand that perspective. My family, the Fortistar family, we're very focused on sustainable investing. But I think that there's a long way between here and there to say we can all live on sunshine and wind. It's 13% of the United States grid power. Electrification is not a fuel source, and we need all types of energy investment. And actually, one of the things that we fear, particularly when I was at Bessemer and today at Fortistar, is if we have a period of uninvestment or too low of an investment period, we're going to wind up in an energy crisis, which is not that hard to envision given the uncertainty around the investment environment, particularly the public market side. So I would say the smart LPs I know continue to invest with great GPs. The LPs who are more reactionary, who are more finicky, are the ones who tend to have, in my historic experience, less steady returns over different cycles. And it's not the best way to think about any type of investing, let alone energy.
So let's hear from our GPs. Kathleen, what's your perspective on this?
Well, I think those were the comments that Chuck made were very insightful. I do think, and it does take everything right now. We have about 7.5 billion people on the planet. We still have 1 billion people without reliable access to energy, and energy is essential for economic prosperity, but also for health and safety. So it's essential. We also invest, as do my fellow panelists, in green energy, and I think there are different definitions of what's green. That's maybe another whole panel. But let's say renewable energy sources, solar and wind. But the sun doesn't always shine and the wind doesn't always blow, and we see that in California right now. If anyone, and certainly with the wildfire smoke, et cetera, really exacerbating the situation. So right now, until we solve for long-term reliable battery storage, we need energy. We need it to be cleaner. There's absolutely no question. We need it to be reliable, and we need it to be affordable. And that takes everything. And there's a lot of infrastructure involved in delivering that, getting the energy, from the source to the end consumer. So I think there are a lot of private investment opportunities. Certainly, the amount of capital spending required swamps any forecast of public ability or government's ability to support these things. So it's really up to private capital, and it really is essential. And I think we can do it responsibly. We can, ESG is important, and we can do it safely, and we can improve and get cleaner. But it really will take everything.
Oh, how about you, Gary? I was on mute.
Well, when you asked, I thought it was there's that old prosecutor joke. Have you stopped beating your wife, sir? That kind of applies to what are investors thinking about energy? Because that implies investors are thinking about energy. There has never been a time in my career, and I'm sure the same with Kathleen's career, where energy has been less popular of an asset class. I think it is really, there's 4 reasons for that. One is, sort of historical miserable returns over the last decade. Second is the ESG issues that people have talked about. I think the third is sort of excess volatility relative to other asset classes. And the fourth, to a point that Chuck made, is sort of poor liquidity from older funds. So I think even LPs who kind of have a steady as it goes approach to the energy sector also face, funds from 2008, 2009 that have not returned capital. So, you have for oil and gas private equity, unimaginable 5 years ago, low demand for strategies with really a few contrarians out there. I think for infrastructure, broader pooled infrastructure, you have continued, obviously, demand for that. And I think clean energy, you're having a growing demand for it, but it's still a relatively new asset class with its own historical shitty returns that people have to get over with in sort of a clean tech 2.0 or growth equity strategies. So it's pretty, so I think, and for the most part now, you look at, energy in the S&P 500 is like 2.5%, Apple, 4%, 5%, Microsoft. So it's, if any, it's not even thought, it's not even thought about. If it's 1/50th of the market versus 15% of the market, it's really become something you don't have to pay attention to. Other than that, it's great.
Well, I can tell
Michael, I might just jump in and say,
Sure.
adding to what Gary said, which to paraphrase, energy became a 4-letter dirty word, even though it's 5 letters. But I think, Gary did mention volatility, and Chuck has a lot of experience with this, being on the buy side. It's funny what we've just learned in this pandemic, because in infrastructure land, about 75% of the deal flow has been in energy and power in the last 5 years. If you expand it to include things like water, and which includes hydro, that's over 80% of the deal flow. And folks were saying, wait, we don't want that volatility, and we want resiliency. So we're going to diversify and get into things like transportation. And that was all great until COVID, and airports went down 50% or whatever it was. So I think it's the devil's always in the details, as which is why this asset class is so interesting. You really have to dig deeper and get down, to really the nitty gritty, of these strategies.
Yeah, and just to kind of add my 2 cents to this, my family's been investing in energy since, oil and gas since 1999, both on the private side and on the public side, and then we've also invested in. If you want to call it renewable or green, we're an early investor, for example, in Tesla. We also own mines which produce lithium and cobalt and copper, which go into the, all these electric vehicles. And I really think it's going to be a portfolio approach. If you look at companies like ExxonMobil, Shell, BP, they are all taking and making investments in renewable energy. They kind of see the handwriting on the wall. But I still think, and I think it was someone, Cathleen from BlackRock, a couple years ago, when I was participating, who had a chart about the consumption of oil per person. In the United States, it may have gone down now, but it was about 7 barrels per person. But in India and China, it was something like 2 to 1 or 1 to 1. And that's where I think there's a lot of opportunity, is in the developing markets, which is still industrializing to some extent. And I think that's where you're going to see a lot of the growth opportunities, in my opinion, in oil and gas going forward. I still think there'll be room for renewables there, but just, places like India, places like China, places like Africa, even places like Latin America, there's still room for a lot of growth in the oil and gas sector. As kind of a corollary question to that, given that there is some economic uncertainty, climate uncertainty, are you seeing LPs, this is really for the GPs, are you seeing LPs looking to, instead of necessarily investing in funds, maybe doing more direct investing, co-investing, given where you may not be able to, project in a typical, say, 10-year, 12-year, 15-year private equity? Are LPs asking for more, I guess, different structures of investing as opposed to your typical kind of GP LP? And maybe Gary, you can go first on that.
Yeah, I think for sure. I mean, a blind pool energy private equity fund, completely uninvested. As I mentioned, a fully invested, private equity energy fund may have no demand. So a blind pool has even, less than zero demand, I think now. I mean, we'll see with a few groups doing it. So clearly, the few contrarians out there are seeking either direct investments with kind of with a fund, sort of as you and Chuck kind of do, a sort of a relationship tip, if you will, or they're looking to be in the last close of a fund and effectively let the GPs play each other off, to get capital from early supportive investors to put assets into the ground and make a decision at the final point when hopefully, what all LPs want is, those investments already showing progress, already being marked up, get infinite IRRs and all that fun stuff that everyone wants. So clearly, linked co-investments or very heavily seeded pre-specified funds are what's necessary in a market like this. With the exception of a few very supportive LPs, you'll maybe obviously be able to get you off the ground, but that's getting increasingly challenging.
I mean, Chuck, wouldn't you say this comes really down to portfolio construction issues, even in a broader way? Because co-investment is a way people use to shape their portfolio and to customize.
Yeah, so we took an approach like that. It was a way to complement kind of satellite core, and core was our GP commitments, more diversified, and our co-investments were more concentrated, shots on goal. We made an active decision to join alongside. I think one of the big challenges around co-investments for LPs is, do they actually have the right technical capability to make good decisions, and what's their approach to co-investing? And I think a lot of LPs, from my perspective, got into it as a way to demonstrate lower fees. And I think that, from a personal perspective, that's the wrong approach. Whether at Bessemer or at Fortistar, we always took an underwriting approach, made an active investment decision based on the what the manager told us and what we could independently verify. But I also think it's hard for any sizable LP to get a fully diversified co-investment portfolio that doesn't have adverse selection bias at any scale. So I think there's a balance in the ecosystem between the GPs playing the role that they've traditionally played and offering some of the co-investment opportunities in terms of a partnership, as well as a way to keep the pipelines open.
So Chuck, kind of playing off that answer, since you are, an LP in funds and we've been LPs in funds, I'm curious what your opinion is what do you look for when you're looking to become an LP in someone's fund? What kind of the characteristics of the GP are you looking for in this space?
So our approach was always an alignment of interest, looking for a good partner where there was a two-way dialogue. We had the luxury, whether at Bessemer or at Fortistar, to not have to write huge checks, so we could be more selective in terms of the GPs we could work with. And so the alignment of interest between the GP and the LP was critical. The second element was the GP's ability to differentiate itself in a market, whether that was by a sector approach, a technical approach, a capital deployment, risk mitigation, and then third was did we actually think that what they've achieved in the past was repeatable, and was the team that we underwrote, are they going to be the ones who actually execute in the market, and do we believe that they have the depth of team and the discipline to actually deploy capital in a way that's going to make us excess rates of return.
Yeah, I mean, from our perspective, we echo a lot of those sentiments, but we kind of think of ourselves as a operator with a private equity mentality, which sometimes is almost an oxymoron. And then, so when we do become LPs in someone else's fund, we're looking for characteristics because sometimes a good operator is not the best person to deploy capital, and sometimes the person that's the best to deploy capital really doesn't have that operating experience. They haven't been on the field. They haven't been on a well. I can't tell you how many private equity funds where the managing partners have never been to a drill rig, right? And so we're looking for GPs that can show both characteristics. They've rolled up their sleeves. They've gotten their hands in dirty in the field, but yet they have the kind of fiscal responsibility when they're deploying cash, right? I mean, the old adage in the energy field in the energy space is you're dealing with a bunch of wildcatters, which is somewhat true. I mean, a lot of my clients, that's how they made their wealth, being basically wildcatters. But those people are typically not the best protectors of capital. So finding that right combination, you could say it's kind of a needle in a haystack, but finding that right combination are the people that the teams that we're going to back that show both the operating expertise, but also are fiscally disciplined. Because this is a business where it's capital intensive. It uses extreme amounts of capital, offshore, onshore, it doesn't really matter. And so you want someone, you want a team that has those type of characteristics. And that's the way we look at it.
Has that changed? Just get the panel. I think we're supposed to make sure that we are addressing. You sound very clear, Michael, in what you want, what you're looking for. But I think folks are asking, like, has that changed during COVID at all, or in 2020? And probably be interested to hear from Chuck the same. Really, have you pivoted, and what is a temporary pivot and what's permanent?
So I'll share from a overall thesis. I don't think anything's changed from a GP relationship. I think that those things that I stated are still very much what we're looking for. From a current environment and from a opportunity set that we're looking at today, a lot of what we focus on is the technologies that can make energy more efficient, more stable, cleaner. And so we've been spending a lot of time. There's a lot going on in the hydrogen space. There's a lot going on in renewable natural gas. There's the storage conundrum continues to be a challenge. And so from our standpoint, we have a lot of renewable energy that's kind of renewable natural gas. We're looking for technologies that can help the traditional upstream stuff. So whether it's methane monitoring and repair, whether it's extraction techniques. So we've been spending more time looking at the technologies that support the traditional energy infrastructure, where we think that there's an opportunity for both economic benefit as well as some, environmental and business sustainability practices. Because we think we're partners with some of the big guys on some of the companies. We have a carbon capture company. The big oil companies are, to Michael's point, looking to diversify. But also to Michael's point, I think that it's not a natural place for them. So we've been looking for either wildcatters, technologists, GPs, where we can bring some of our, I call it a translation between the venture and growth guys speak French and the infrastructure and oil guys speak German. And I view us as an LP who can help bridge some of that gap and be the connection points between us. So that's a little bit of COVID. It's also a little bit of just where we've evolved from a technology standpoint and where the world is today.
Yeah, I would say that one of the areas that we've been heavily focused on is actually more on technology side of the energy business, whether that's enhanced recovery, whether that's monitoring, as Chuck has said, whether that's 3D imaging, whether that's even cybersecurity around IoT, because oil wells now are using more and more sensors. It's more and more data. We like big data in general as investors, and we're seeing the energy and in the mining too. We're big in mining. Those industries start to go more into data, and we see those as some great opportunities. The other space that we have a frac water company. We're looking at other frac water type technologies. It's getting harder and harder to dispose of frac water. So we're looking at other water management type, either technologies or companies or funds or whatever. But that's where we see a lot of the opportunities. I think at this oil price and even gas price, it's very difficult to put new capital into the ground. And so we're trying to find ways to get more oil, more gas out of our existing wells, or look for funds that deploy those type of invest in those type of companies that can help us get more bang for our buck, essentially. And that's where we've been focused in the energy space.
So Michael, I think, and Gary can chime in, but that's a great segue to, again, what's changed, what's permanent, what's not. You're talking about, increased efficiency, which is, and technology, and digitalization, and et cetera, can all help those things. And I think those are themes that we see and what we look for when we're investing. Certainly about how how strategic, is an asset, what kind of resiliency will it have? I think all GPs are, have improved their stress testing, in light of 2020. I think that's going to benefit the entire industry. I think we should ban the word unprecedented or black swan, and just to say, so I think that, and I think, in fundraising, what it comes down to is how is that going to translate? Getting back to the topic, I think, and you, Michael and Chuck, will correct me, but I think we'll be answering these questions for many years. What did you do as a manager to help and improve your investments during 2020? What were your takeaways? Show me that where you've incorporated these changes. Show me your due diligence checklist. Is it twice as long, twice as robust, et cetera? How did you take advantage of the downturn? How did you pivot? I think it's just going to be another way to judge managers. And I think it'll add to the sort of haves and have-nots in fundraising. I think those who were, extremely diligent and innovative, but yet, stuck to their strategy and knew their strengths, I think they'll be rewarded going forward. But Gary, you should chime in.
Did we lose him? No.
Gary, you're on mute. Still on mute. I don't know if you can hear us.
I think we only have 2 minutes, so
okay,
that'll be a
classic
mute
fail. The classic mute fail. I think Kathleen, you're absolutely right, and I think we just have to keep in mind oil and gas private equity is a shrinking asset class because it rose from a very niche asset class with 8 to 9 funds closed a year to one with 25 to 30 funds closed a year during the shale revolution that has had tremendous impact for the world, for energy, for the United States. But it's had, very mediocre to negative returns across the board for investors. I think as we head into this transition, it's going to be a smaller asset class. It's going to be one where clearly clean energy and the energy transition is going to play a role. There are major sources of capital consumption in there and power. There's also not clear, where private capital is necessary in some of those areas versus technology and sort of more nichier projects. So I think it's definitely Never has there been, sort of darker days, I think, for this asset class. I think never, but it's also one where there are opportunities, and it's going to be the names on the board 5 years from now is going to be very different from the names on the board 5 years ago. And, it's up to everyone on, Kathleen and my side of the table, and folks that, playing both sides, like Chuck and Michael, to kind of figure out, how do you be one of those names 5 years from now?
Okay, I think we are out of time. I just want to thank all the panelists for being on this panel, and I think hopefully we've given the audience some good opinions in why we should invest in energy and what are the challenges in investing in energy. And I'd like to thank everybody, including Super Return. Okay, I think we're
Thank you,
done.
everyone.
Thanks.
Yep.